Good evening and welcome to the Masheleng Money Podcast, where we discuss issues surrounding financial literacy. I'm Nelo Mukhots, and on today's episode, we're discussing how investors need to be emotionally prepared for the market fluctuation. We are with Mr. Tiro Howard, a business development manager at Corey Capital. Corey Capital is a business that offers local and international investment solutions. Tune in.
Thank you and welcome to Masheleng Money Podcast, where we bring you conversations around money. We talk about investment, we talk about savings, wealth creation, estate planning, anything you need to know around the issues of finance. We try to break the barriers between those who are rich and those who are poor, because understanding money can only elevate you. So today we are talking about investor emotions. We will be talking to Mr. Tiro Howard. Mr. Howard, thank you so much for joining us at Masheleng Podcast.
No, thank you. The pleasure is all mine. I always enjoy the time that I spend this side Masheleng.
Thank you so much. Mr. Howard, before we start, I just want you to give our viewers and listeners just an idea of who you are when it comes to matters of investments. How far have you done it? The experiences that you have garnered over the years.
All right. So at the moment, I am a business development manager with Corey Capital, which really means that I deal with finding new clients for the business, with servicing the clients that we already have, ensuring that our client base grows, and just basically looking at our long-term strategies and seeing how they sort of incorporate our business objectives.
Yeah.
I have spent quite some time, actually the better part of my career, as a financial planner and an investment advisor, which therefore means that I've spent a lot of my time dealing with people's finances, helping them to achieve much better with the finances that they have, helping them plan for their children, helping them plan their estates. It's a job that I very much enjoy doing. It's something that I still do in my private time. It's something that I'm very passionate about because for me, having been in that space for so long, I believe there's a lot of joy to be had in seeing one of my clients reach their financial goals.
And I can imagine, you meet a client today, they are clueless on what they want to do or how to structure their portfolio and stuff like that. And then you chat with them, you guide them through the process, and then a few years later, you find them, they're living well, they're so happy. They give you feedback. Mr. Howard, since the last time we spoke, I managed to dispose of that asset or that and that. I managed to do this, and it's working perfectly for me. Right? It's really a passion business. I don't know if a lot of people, because nowadays we have quite a number of financial advisors around the market. People graduate with finance from school and then immediately they become financial advisors. I don't know what is your take on that. I was just having a conversation with one of my colleagues earlier. She was asking me why do we charge what we charge, right, for advisory services. And I gave you an example of a lawyer or a doctor. The older they get, the more experience they have, they charge more. But funny enough, with finance, people want to restrict advisors to a particular fee, whether you are 20 years into the game or you are a year into the game, or what has been your experience when you dealing with people, whether you charge or don't.
Okay. I think there are a couple of facets to your question, right? The first one is, yes, at the moment, financial advisory or investment advisory, it really has to come from having a passion for it, right? I am grateful that a lot of people are graduating from finance and they're going into financial advisory. Whether they're passionate or not, right? Because I believe the more sort of qualified, skilled people that we can have in the financial advisory space, the better for the clients, because you'll appreciate traditionally, especially in Botswana, financial advisory is a space where someone who's not even qualified will go into. Now that sort of leads into the other facet of your question of why the charges don't seem to grow over time as experience grows. Now, unfortunately, we're probably not as tightly regulated as other markets. If you look at our sister just across the border in the name of South Africa. So the financial advisory space is a very tightly regulated space where you have to take regulatory exams to become a qualified financial advisor. You have to carry your financial advisory certificate of approval from the Financial Services Board. To basically qualify yourself in front of every client. Now, what that does is it turns the whole space into something of a niche, right? Because not everyone is willing to go through the sweat, blood, and tears of becoming an actual regulated financial advisor.
Absolutely.
And when you don't do things the right way as well, there's heavy penalties to bear. So if I'm not a qualified financial advisor, but I give financial advice and the Financial Services Board eventually finds out, there are heavy penalties to bear, right? So you find yourself maybe not too enticed to go into financial advisory until you're qualified to do so. Now, I believe we're getting there. I think NBFERA is doing a very good job. We will get there. Financial advisory is definitely a service that should be paid for. If you look at, like I gave the example of South Africa, if you look at the United Kingdom, if you look at even the United States of America, basically if you looked at developed financial markets, you'll realize that financial advisory is actually one of the most handsome paying professions.
Yes, absolutely.
And if you look at, for instance, jobs that probably will not go extinct because of the advent of IT, the advent of robotics, etc. Financial advisory is somewhere at the top there. If you look at jobs that will be needed for the coming generations, financial advisory is somewhere at the top there, right? The same probably is not true at the moment for our market, right? Which is sort of what brings the fees down. Anyone can wake up and become a financial advisor, when in fact what they're doing is being a product salesman. So those are the challenges that we have to deal with, but I'm always happy when we do have qualified financial professionals entering the market. Also qualified financial professionals who have a conscience, because as a financial advisor, it's not just about making the next sale. What you're actually doing is you're taking the future of the person before you, you're taking the future of their family, their children, multiple generations. You're taking it into your hands, and so if you don't give the right advice, you're basically compromising a whole structure, a structure that starts with the client before you, that trickles into their family, basically their spouse, that also trickles into the generations after them, so that's their children and their grandchildren. So it's a profession as well where you do have to have a conscience. So even when things are tough and you do need to make the next sale, it shouldn't be your priority.
I think it's that's something that needs to be debated on, or we should be having conversations around that often, because when we engage with various financial institutions, more especially financiers, the thinking is always that if people are a lot more learned, if people are literate when it comes to matters of finance, there's a possibility that business might drop. But we argue that when people are literate, business will go up. for financiers, for different financial institutions. But if we don't focus a lot more on the education, we'll always struggle. I mean, our penetration on various products, it could be investments and all, it's very low, as a country. We are highly penetrated on financing, on credit, right? And when you drill deeper, to understand where the credit is going or what credit is being taken out for, credit is it's supposedly supposed to help people to get to the next level, right? To help people to create wealth. That's really what debt was meant for initially, for productive means, right?
Right.
But because our people, they have a long way to go as far as understanding how finance works. They only use money to consume, to buy clothes, to buy food, and then that's it. You look at the debt bill right now in the country, household sitting over 60 billion somewhere there, and that's a lot. I mean, we should be rich, most of us.
True.
If
true,
you've accessed anything more than 500,000, I mean, you should be rich, right? But we are not. I don't know. From your side, your observations, your experience. Do you ever get people? I know you are on the fund management side, which basically speaks to mostly investments, wealth creation, and the like. Do you ever get people who come through with inquiries of, I want to get debt to help me to establish my portfolio? And you sit down with them, you advise, instead of someone coming and saying, look, I have bulk money, I want to put it in, I had a job, or I have money that I want to put in every month. Do you ever get people who are thinking of getting debt to actually come and invest, to boost their portfolio?
All right. Again, I'll answer your question in two facets. So the first part of what you're saying, you're basically talking about our credit levels and how there's a school of thought that the more literate we get, perhaps business will drop. And I'm assuming this is more for lending institutions. So right, well, I mean that is partially true, right? But even from from a bank perspective, there's two things you have to worry about. You have to worry about getting a client to come and take credit from the bank, right? But you also have to worry about the back end of things, which is ensuring that that client keeps up with their payments. Right? So if you look at bank financial statements, there's something that they call impairments, credit impairments.
Yes.
So this is basically how much of their loan book that they have to write off because the client simply cannot pay. Right. So this is also something that is a big concern for lending institutions.
Yeah.
So there's a sort of a bridge there that can be gapped between getting the credit and ensuring to keep up with monthly payments or biannual payments or whatever it is. So as we get more literate, it's a win-win situation. We become investors, right? So we don't just take on credit, we become investors. But at the same time as well, when you do take on credit, we take on credit that we can afford. And as you're saying, we build wealth with that credit, and that wealth helps us with those repayments on the credit, which also then means smaller impairments for lending institutions.
Yeah.
So it is, listen, we're a long way from there into building a financially literate culture and to building an investment and savings culture. But it will be when we get there, as we're getting there, it's a win-win for everyone. And then the second part of your question, which was, do we get inquiries from people who want to take on debt? Perhaps not really, especially from an individual perspective. We don't really get many individuals walking through our doors at Khori Capital to come and inquire about debt, right? Because what we do is we're investment managers.
Yeah.
However, we do sometimes get companies, well-established companies with good levels of corporate governance and very strong balance sheets that might want to explore some level of debt with us. And this is something that can be taken up by our investment team. We've got an investment team that undertakes very strong, very rigorous research, does a very rigorous due diligence to see if our client funds can be placed with institutions that come to our door, like I said, to come and explore debt funding, right? However, our core business, like I said, we're investment managers. So when we do that, it's purely to fund or to find, opportunities for our clients, of our client pool of assets. Right.
Yeah. No, absolutely. So we we had training this past weekend. We were basically talking about fundamentals of investing, what people need to look at, why invest, and all of those things. So there's a question which always pops up, and this question is, say I have 100,000 and I want to do something that can give me value, or something that can grow this money in the shortest possible time, right? The question always comes up. So I just want to get a feel of how you would answer that. Now this speaks to the topic that we'll be getting into after the break. So I want to know how you would address the question, because I always address it the same, but maybe the way that I address it might not be appropriate. I just want to hear from you. If somebody says, I have 100,000, I want to create wealth, what do you think I should be putting my money on in order to be able to grow this cash?
All right. No, thanks. You're right. It's a very popular question. Now, unfortunately, it's not a one size fits all sort of answer, right? Because we're very different. That question opens up other questions. Like,
yes.
What do you do for a living?
Yeah.
Right. How did you acquire that 100,000 to begin with? So what's your income generating activity at the moment? The reason why that's important is because if you are fully employed, right? So if you work 8 to 5 or 7:30 to 4:30, like most people do, Monday to Friday or Monday to Saturday, then what that means is you're probably looking more at passive means of income than actively investing that 100,000 yourself. However, if you do not have an income generating activity, so say for instance, this is an inheritance, the 100,000 pula is an inheritance, then you probably want to have part of it going into an active investment. So re ka re go bula se mausunyana, go reka dio tse pedi tse tharo, o reka o rekisa, jalo jalo, because o na le nako ya gore o ka dira jalo. Ga ke mme ke rata go rotloetsa gore gore ha o tshwere shilling nyana, we tsenya into an active investment. Remember, in an active investment, you're sort of the biggest resource or the biggest asset in that equation. And ultimately as well, then you become the biggest risk, right? So koroska tsenya thebe ya gago yotlhe into an active investment, because gore hela o tshwarwa ke flu, madi ona ntsa tsamaya ka kwa. Gore hela o tshwarwa ke tsele le tsele, madi ona ntsa tsamaya ka kwa. Gore ha o ithuta se ileng goreng wa se dira, ka gore ga ngwa kere o itlhala le gore o tsena mo kgwebong e se kgwebo e o itseng. Mme yaanong ha o ntse o tsweletse ka go ithuta kgwebo eo, madi ona ntsa tsamaya. Jaanong ha o tsentsa 100,000 wa gago gotlhe mo go yone kgwebo ya teng, gore o ka tla wa nna le mathata. Mme if you split it between an active investment, o bona le a passive investment. Passive investment the ra mo ileng gore o ba madi mo peeletsong, peeletso a ke yone investment. O ba madi mo peeletsong, madi a tebe nona go berekelang. madi a teng e be le goreng a managewa ke, let's say, investment managers kgotsa e le gore wa tsenya mo bankeng, say into a fixed deposit, but basically a managewa ke experts or professionals in managing that money. So the chances of you getting your money back, or at least getting your principal back, are reasonably high, right? So it's not as much risk as an active investment. So go tlhole go le botoka o ka bakantse gore o na le yone that active investment e leng gore you can get your hands dirty with. Me gape o na le a passive investment e leng gore ha ka ha go shota o tlhoka go thiba diphotlha o kgona go tsaya from your passive investment o tikela ka. So it's a question e leng gore there's no one size fits all equation. You know, we have to assess, like I said, what are you currently doing now? What do your do you really have a lot of time on your hands? We also have to look at your long-term and your medium-term objectives. Gore wena me gona mo botshelong o batla go iphitlhela o le kae? Ha ile gore motho e leng gore o batla go iphitlhela gongwe ke ha se kae o una kgwebo at some point e leng gore it's doing very well.
Yes.
You know, then there's always no better time to start than now. So you might want to take a risk ka a portion of that capital wa tsenya mo kgwebong e leng gore e managwa ke wena. So that's why it's important to look at long-term and medium-term objectives. Ha ile gore motho e leng gore tota wena gongwe o batla go tsena sekwele gore o batla go iphitlhela o le professor, then maybe you don't really have time for active investing. Then what you should be doing is passive investing, right? Jalo jalo. So your circumstances are different for everyone. So it's something that you need to sit down with a qualified financial planner or a qualified financial advisor. Ke ena ba bona goreng tota tla ke re le le mmogo ke gone e be le bona gore wena se se matshwanedi mo go yana ke.
Yeah. No, I like the way that you've answered it. You know, that's really what people need to get to understand. Unfortunately, we have we have scammers out there, right? And you know, scammers normally they take advantage of people who believe money can be made quickly. So the moment you come and say you have 100,000, you want to double it, you will find a scammer. And a scammer will tell you we can double it. We can more
Unfortunately,
than.
yes. And one of the things, actually, sorry to interrupt you there, that I wanted to talk about is hela ha motho I've got 100,000 pula, kgotsa ke tshwere 10,000 pula, whatever amount it may be, a ba re make batla returns in a very short space of time. Ke go mo e leng goreng for me is a very big red flag. Gore hela ha o batla madi a go boela in a very short space of time, then the chances tsa gore madi a teng wa lose kgotsa go latlhegela in a very short space of time are also very high.
Yeah.
So it's just something that you need to look out for. Yeah, sorry,
And
back to you.
I always like to ask the question when people say that, to say, instead of us talking about how much you want to make, right? Let's look into how much you are willing to lose, because everybody wants to make a lot of money. I mean,
Exactly.
if I was given an opportunity to tell you know, a portfolio manager how much money I wanted and they can make that, everyone would be talking 100% profit, 200%, right?
Right.
But now the question would be, how much are you willing to lose? You give me 100,000, are you willing to lose all of it? Because if you are, there are certain investments that you can get into, right?
Right.
If you are not willing to lose anything, there are certain investments that can protect your principal, you know, amount, but maybe making small interest there and there, right? So the question that needs to be answered most of the time is, how much am I willing to lose? Because most people invest a lot of money, you know, in very, very risky investments, but they don't want to lose anything, right? The moment they come, they find that their fund has gone a bit lower than what they had actually given, because markets react in different ways. They go all out shouting, "I've been cheated!" You know, even when they are dealing with a professional, you explain this thing to them. I don't know. Sometimes maybe they block it in their mind to say, "Look, I've given money to Tiro. I know Tiro will make me profits. So tomorrow when you come and you tell them, you know, let's look at your portfolio. This is what has happened. We've had a knock there, we've had a knock there. Markets have been performing like this. You give them that analysis, they're not even listening.
No, true.
Yeah.
True. Today we're talking about investor emotions, right? And I'm sure we'll discuss and we'll dissect the topic in full.
Yeah.
But investor emotions really boil down to two emotions.
Yeah. Before we go on with that, I want us to take a quick break, and then when we come in, I want us to drill deeper into emotional.
No, that's fine.
Yeah, absolutely. So if you're just joining us now, we are discussing investor emotions. Can I Mr. Diro Howard from Corey Capital. So please stay tuned. We'll be back shortly.
Hi, I have a free gift for you. If you want to claim this gift, go to www.masheleng.online/gift. In this gift, you will learn how to become financially free in 5 years or less.
Welcome back. If you are just joining us now, we are talking about investor emotions. Can I Mr. Diro Howard from Corey Capital. Mr. Howard, before we went for the break, investor emotions. We are talking about a lot of people want to just gain, they don't want to lose. But investment, it's something that, you need to know that there are risks associated with, investing. So you were just I'm trying to go deeper into the investor emotion part, because I get there some maikuto kgotsa ditshwetso.
Tota, as humans, more than anything, we're emotional beings, right? So ke ne ke re ke tlhalosa gone gore o bua nnete, re le di-investor re na le gore re tlhaloseditswe sengwe le sengwe, hela ha re bona thebenyana e simolola gore latlhegela ebe re tsieditswe. Mme go tota go irwa ke gore investors or investing, there are two main emotions involved, right? We'll go deeper into the realm of emotions as an investor, but there are two main emotions involved, and they're fear and greed. So when you start investing, your decision to start investing is either based on a fear, so that's usually a fear of a liability that you are aware that you need to meet in the future, right? Greed. It's maybe a bit crass as a word, but really what it means is you're looking to make, or you've been enticed to make some profits on a capital outlay that you already have. Now, the unfortunate thing is the same two emotions that start an investment journey, right, are the same two emotions that will sort of dictate the investment journey. Jaanong, hela ha o simolola go bona portfolio ya gago e nna in the red, fear starts to take over. Right? And that's when you cry foul, you want to sell out. You believe you'll never be in the red. But at the same time, when you are in an investment, let's say in years where, or in events where stock markets tend to do very well and you're invested in the stock market. So now, unfortunately, those two emotions, like I said, they sort of dictate your investment journey. And it's actually managing those two emotions that will either make your investment journey successful or an absolute loss, right? But it's managing those expectations, managing those emotions that will really, really help you in the end. And so when you meet a qualified financial professional, an experienced financial professional who takes you through all of this, that is how you eventually become successful when you're investing, to know to manage your fear to know that it is expected that you should be a little bit uncomfortable when financial markets are in a downturn. To also know that you shouldn't be too excited when financial markets are doing extremely well, right? But basically to keep that balance of emotions throughout your investment journey. So it's just something that has to be managed. And one of the best ways I found in managing it is always to be dealing with a professional, right? Another way, and we'll explore this as we go on
To help
with our
calm you.
conversation. Exactly, to help calm you down. But as well to have, longer term objectives. Ha o re simolla peeletso re simolla hela ka gore mme se mamang ke tsanang ke rekele ene o tsentse madi mo peeletsong yone ya teng exactly
Yes.
kgotsa re se mamang ke palamang dikuta le ene o tsentse madi mo peeletso ya teng e be a dira madi mo go yone, right? Wena o sa lebelele diemo tsa gago, o sa lebelele maikaelo le maitlamo a gago mo botshelong jwa gago, especially in the long term. Jaanong ha o na le a clear outlay ya gore wena tota mme o batla mo botshelong jwa gago one mo peeletsong ya gago in the long term, then it becomes a little easier to manage those emotions.
I think like Ubua, I'm just thinking gore go na le batho ba e leng gore ba ne ba simolola gongwe ba reka diabe, and then ha ba senona ba reka diabe gongwe company ne na le promise ya go gola thata gongwe go sentse go simolola a be batho ba le bantsi ba ta go lemoga sephiri se sa gore company ya gola ba le bantsi ko morago ra gore gongwe yaanong batho ba taka bontsi go phika price ya diabe tsone tseo. So gantsi batho ba e leng gore a ngonne go ba direga letse yalo, maybe gongwe you had put in 100,000 and now you are sitting on a value of 1 million on the same shares. You've gained value ya 900,000 over time. And excitement a teng nako nngwe ga gongwe kgona go dira gore motho a akanye gore ene ke mastera wa itse, a ba bolelela ba bangwe gore ene ke mastera wa itse. Gongwe like o bua go botlhokwa gore a bona le motho e leng gore ke expert ke ena ka go thusang go khama, because le ha o dirile madi ona a mantsintsi yalo e kgona gore o morago re yaanong ke a go rekisa ntu le dikgomo yaanong ke tsenye gape gore yaanong madi a nne mantsi le go heta ba re ga re tsamaye ka tsela ntseng jalo, even though re a bona gore ya tsamaya gola batho a re tswelele e gole ka one madi a ne re setse re a tsentse mo teng a mangwe a re leke ka ha bokete. I think that is very important because le nna personally I meet a lot of people who claim to be very, very good at something because something was happening that is good to that particular investment, and then a be gora gore e mo direla sente. So gantsi le ona ha le kopana le motho e leng gore maikutlo a gagwe ko ona e leng gore ke a mante, ke a monate because a particular asset class was performing very well, and then ba feel gore yaanong ba batla go tsenya so se ntsi mo gone mo ke la gore how difficult is it to actually convince those people gore it's equally important for them to diversify well.
Listen, it's not an easy conversation to have, right? But it's a conversation that must be had because, like I said, throughout your investment journey, it's those two emotions that you really need to manage. Right. So, as someone who chats to our clients quite a lot, I also understand very well that it's those two emotions that I need to manage with our clients. Because, like you said, markets tend to do very well. Or certain asset classes tend to do very well. Maybe not so much, right? And in both of those events, you have to manage those expectations. Now, one of the most important things is your horizon, right? So, madi a wa tsenya mo peeletsong kgotsa a o irang peeletso ka one ke madi a leng gore ga ona go a tlhoka lebaka le le kae kgotsa wa tsenya mo peeletsong eo lebaka le le kae. So it's something that we'll always have a chat with our clients about. Ha madi a gago e le gore wa go a tlhoka mo sebakeng se se gautshwane go raya gore you cannot take a lot of risk ka madi ao. So a tsenya into low risk assets or low risk funds tse e leng goreng tsone o itlhela gore kwelo tlase ya teng ha e le gore e ka nna teng ga se ka kgaolang motho pele. Mme ha o na le a bigger horizon or a longer horizon ke gore madi a wa tsenya mo peeletsong eo e la e leng gore ga ona go a tlhoka for a long time. For instance ke le tiro yana ke ba madi ko thoko ke a beela for my retirement. I'm still quite young. I've got probably a few decades before I retire, so I can afford to take maybe a few more risks ka madi a e leng goreng ke itse gore ke ya retirement ya me. Jaanong ha ke dira jalo, I can take a little bit more risk. Ha ke kopana le di-client tsa go nna jalo, then we have that conversation ya gore okay, me madi a ka gore o dumela gore ga ona go a tlhoka mo sebakeng se se leele, you can take a little bit more risk with it. And the reason why we say that ke goreng la go ka nna le kwelo tlase ngwagao ngwago tlang gongwe dilo di o hetoga ngwago a boraro hela jalo, mme ha o lebella the longer time frame, because over the longer term markets do tend to do well. I think otherwise we probably wouldn't have financial markets. But if you look at stock markets, for instance, because if you look at stock markets over the long term, you'll find that most stock markets will give you a very decent return over the long term. Or long term, 5-10 years, right? So you get to ride out that volatility. Ngwago tlang gongwe re tswelela ka kwelo tlase mme ngwago a boraro dilo di simolola go nna botoka, ngwago a bo4 hela jalo, gongwe a bo5 go boa go a ko tlase go sekanyana. But if you smooth all of that volatility out, o itlhela e le goreng gone your portfolio is growing, and it's growing at quite a decent rate. Right? So I think tota ke gone hela mo e leng goreng it needs to be managed, and the way to manage it, like we said, is to look at your objectives. Another way, like we just said now, is to look at your time horizon. So if you're going to need your money very soon, then you need to put it in low risk assets.
How I have a bit of history doing the investment through insurance, right? I guess they have a similar model also. What do you need trust? Where they pool funds and then invest in different assets over time. And our observation was that you'd have someone a similar investment and then in 2-3 years they come in. Now they want to cash from their investment, and normally I can tell those investments, they're spread over a period of minimum 10 years, maximum 20-25 years, and so on. So when they come, babata go draw from their investment, chances are they will find maybe what they have put in is lower than what what they see as a balance is lower than what they have put in, mostly because of commission charges and other administrative charges, because they're charged in advance. So they will look at that, and for them it's a rip-off. But I've also had an opportunity to see those who had their policies maturing, after 30 years. Well, I was not there when they started investing, but for some of them, I met them, I was helping them as they were maturing. And most of them, you find that after some time, they have done really well over time. And like, another is that volatility. If you were there in 2008, you would have probably had your portfolio maybe and then from there I be recovering. But the fear that most investors have, everyone is advising ntsha dio tsa gago o di right? So what you are saying we need to be
In
looking at
for the
it
long term.
for the long term. But ka ho buang ka teng, not everyone can do it for the long term. So ora how dira your analysis, o botsa motho gore o madi a sente, what do you want to achieve?
Exactly.
Yeah.
Listen, we would like every investor to be in it for the long term, right? However, that's simply it's not possible.
Yeah.
All right.
Yeah.
So actually, even within a single investor, we can have a short-term portfolio. Yeah, my dear, next year,
Yeah.
right?
Yeah.
And you can have a long-term portfolio. Yeah, my dear, retirement. I in 20 or 30 years, right? So it's absolutely important that you need to establish this, because you gave an example, for instance, an insurance policy.
Yeah.
So an insurance policy, it's investment linked. It's an investment which is insurance linked. I don't know how you want to put it.
Yeah.
It's probably not something you want to take for the short term,
Yeah.
right? However, for the long term, it can work out for you, and it can work out handsomely, right? For the short term, you probably want to look at what we call money markets. So, for instance, we've got money market funds, right? A money market fund basically will take multiple fixed deposits as the underlying investment, or multiple instruments. The bulk of them are short dated.
Yes.
Right? So the maturities get right? And they'll bulk them under one sort of basket of investments.
Yeah.
Right? So that's what you call a money market.
Yeah.
Or you just want to take a fixed deposit or a call account with the bank. So those are still what we'd refer to as money market instruments. So it's very important next year. You need to know the right type of instruments next year. Your balance. What actually can go to you, right? Because also some investments will restrict you more. 5,000 pula in the short term. So these are things that you need to know from the onset. This is a long-term portfolio, so then that shouldn't matter too much to you, but this is a short-term portfolio, and that should absolutely worry you.
Yeah. So tell me, how important is it to study say maybe a particular asset class, to study the history of that particular investment, right? So I always like to give this example. Ray Dalio. Ray Dalio, he's obsessed about history. And he would the system level, it's 500 years ago, and then he will have a whole line is okay, no, on this year this is what happened, every other 5 years, 10 years, this is what possibly happens. How important is that when people want to invest, if they come to you, they want to invest, how important is it for them to ask to see your performance in the past, so that a bit of comfort to say, okay, no, this is how things are going? Because because of lack of information, people come, they expect a huge return on stocks, when for the past 5 years, stocks have been maybe performing but not performing at the rate that people are thinking, right? How important is it for them to access that information?
Right. Again, I'm going to answer that question in two parts. Now, the first thing, which for me is most important, right? As an investor myself, I don't buy assets myself, right? I leave that up to a professional, which is why my own money goes into expertly managed funds, right? Or we'll refer to them as unit trusts sometimes. And the reason for that is I don't want to have to worry too much about what you're just asking me now. I don't want to have to worry about really dissecting, for instance, a stock or a share and looking at, will this share make me a lot of, or will it earn me a decent return? Right. And the reason why I don't want to worry about that is that's not what my profession is. I'm not an investment analyst. I'm not a portfolio manager. So I leave that work up to those guys. Now, when you're investing in something which is pooled, there'll usually be expert managers behind it, and their job every day is to look at that portfolio and look at what other assets are doing better that I could add into this portfolio. What assets do I predict will not do too well in the future that I should be taking out of this portfolio? What assets have reached their limits in terms of the returns that they can add to this portfolio? So that's it's not my job. It's the job of a portfolio manager. It's the job of an investment analyst. Right? So I leave that job up to them. So I don't go picking the stocks myself. I don't go picking the underlying instruments myself. I just put money into pooled funds. However, listen, that's just me, right? Now, the second part of your question or my answer, looking at the history. When you look at the history of either a stock or a unit trust, what you should be looking at, or what it should be saying to you, is the people managing this unit trust, for instance, the people managing the company that I'm buying into. What does their history look like? Do they have a strong history of getting decent returns? So if you're buying into a single stock, for instance, right? If you're buying into a supermarket, for instance, the management behind that supermarket, what history do they have? Do they have a history of making losses? And the way you look at that is looking into the long-term performance of that particular stock, right? And if they have a strong history of earning good returns, then there is a potential that they could continue with this strong history. Then obviously they've got something right. There's something that they're doing right. And if you're looking at a unit trust, for instance, if the expert fund managers behind that unit trust have a strong history of providing good performances on that unit trust, right, in the long term, then again, they're probably on to something, right? The chances are you will make a decent return. However, it's very, very important to always have it in the back of your mind that historical performance does not translate into performance in the future, right? And that's why now when we're investing, we need to think about things like diversification. So when you invest in a unit trust, maybe invest in 2 unit trusts, right? When you invest in a share, maybe invest in multiple shares. Because, things happen, say, for instance, things like seasonality, right? Say, for instance, regulatory issues. So you might be investing into, for instance, a supermarket. I'm going to give that example again, which does have a very strong history of earning decent returns, but there might be a new regulatory issue that is absolutely preventing them from continuing with those strong performances. Right. So sometimes, yes, there is a hurdle that they need to get over, but sometimes, it's something that is very restricting. And now this is where diversification comes into play. When you've got a diversified pool of stocks, when you've got a diversified pool of unit trusts, then, when one goes up, maybe when one goes down, maybe the others are going up. When one goes up, maybe the others are going down. And so what you're seeing in your overall portfolio is not too disheartening. Whereas if you've got your money into one stock, for instance, if it goes down 50% and you had 100,000 in it, it means you've got 50,000 now. And that might absolutely dishearten you and I
think you've mentioned something very, very important. It's important to know who is taking your money, who will be investing, because at times it could be me starting off, right? My business doesn't have history, but I've been an analyst for the past 20 years. And where I've worked, portfolios were performing very well. So it's possible that those that I leave behind who are still invested there, they're investing because of the strength of that particular business. But now the operator is no longer there. So the chances, it's similar to, when you look at stocks, more especially very, very active stocks like in the New York, in London and all. When a CEO of a company is fired, sometimes a lot of investors pull out. Sometimes when a new CEO is appointed, a lot of investors come in because they've been following that CEO. They know his principles, his philosophy of investing and stuff like that. But still, what you are saying is it still doesn't guarantee that you will do well. Maybe they were doing well for so many years because the markets favored them. They took chances there and there with their analysis. It worked, but it might not work in the future. So I think the key point here, which I was getting from your answers, is that only an expert can help you to diversify properly. Because for them is to ensure that you create wealth, but they also protect what you are bringing. Even though losses can be found there and there, they still want to try by all means to make sure that they protect. Which is why I think mo di stock marketeng le gone go na le tsone di indices that tsaya gongwe a pool of different maybe tech companies and say, okay, no, e ke a di-tech company e nngwe yawa e nngwe it's picking, it balances your portfolio, but you don't have to worry about that.
No, exactly. You're definitely right. In the early years of my career, I remember there was an illustration that we were required to make. Now, in this illustration, what we would do is paint a mental picture that is very nice. So you're putting your money into this portfolio. Let us say this portfolio does very well, 9% a year, for instance. How do you feel? And you describe to me, I can see myself having the holiday that I've always wanted to have because my portfolio would be doing well. Now, as you're describing that, as soon as you're done, we take that picture away from you. Now we say, imagine if for the next 5 years your portfolio doesn't do very well and you lose money. How do you feel now? And the reason for that was just introducing to the investor that things can go right, things can go wrong. However way things go, we need to be managing this risk, right? So it was basically introducing the concept of risk to an investor. And it's something that's very, very important because, listen, stock markets do well generally in the long term. But you need to know that in the interim, there are shocks that can happen. For instance, COVID happened. When COVID happened, there was a huge sellout because nobody understood. It was the first pandemic that we had that affected financial markets, especially to that extent, right? So even professional investors didn't know what was happening, right? I remember when we went into that first lockdown, I didn't understand what a lockdown was because I haven't seen a lockdown in my generation, right? So if you're an investor who maybe had all of your money in one stock or in just two stocks or in one particular, say, unit trust or mutual fund, whatever it may be, then you have every reason to worry because if there's a huge sell down or sell out in that instrument, then you can lose a very sizable portion of your portfolio. But if you understand what risk is at the very beginning of your investment and you start to mitigate that risk, okay, instead of buying into one stock, let me buy 3 or 4 or 5, right? Then what happens is, even when there's instances of a lot of market volatility, you find, say, for instance, the New York Stock Exchange, if there's a sellout, if there's a sellout or sell down of, let's say, 20 to 30%, maybe your portfolio, you've taken a knock of 10%, or you've taken a knock of 5%. And basically that's because you didn't just buy from New York Stock Exchange, you also bought from Botswana Stock Exchange, you also bought from the South African Joburg Stock Exchange, you also bought from Cape Town Stock Exchange, etc., right? So the whole point of understanding risk at the very beginning of your journey is to deal with it, or to cater for it, let me say, at the beginning of your journey, so that when market shocks happen, you at least have the comfort that things won't be as bad for you, right? You have the comfort of knowing that yours is an expertly managed portfolio. You've got stocks that behave differently. So say, for instance, during COVID, I'll give that example again. If you had stocks in pharmaceuticals, if you had stocks in information technology, I mean, those are stocks that tended to do very well during the COVID era. If you had stocks in aviation, those probably didn't do very well. If you had, if you had stocks in tourism and hospitality, those are stocks that probably didn't do very well during COVID, right? So when you have a balance of all of these stocks, what happens is when some go down, some go up. And so even if your portfolio does take a knock, it's a knock that emotionally to you is not too distressing. Because eventually, like I said at the very beginning of our conversation, what will determine an investment journey, a successful investment journey over a not so successful one, is how you manage your emotions from the day you start investing until the day you go out of those investments. Because what tends to happen, again, going back to the COVID era, is a lot of people went into panic. Like I said, even professional investors included. And so what they did is they sold out of their positions. So maybe they had a great stock, but that stock is not doing so well. And it's not doing so well because of COVID, because everybody's under lockdown, because nothing is moving. But it doesn't take away from the fundamentals of that company, from the fundamentals of that stock, right? And if you just stayed in it a little while longer, right? If you had managed your emotions, right, a little while longer, if you say, okay, no, I can see the stock went down by 15%. However, when I went into the stock, I did, or my expert fund manager did a lot of research into this company. They've got a strong conviction on this company because of the fundamentals of this company, right? And I believe that when things change, this company will continue to do very well, like it has done very well in the past, right? So if you've got that position, if you can assuage, I did my research before I went into this investment. Then you can stay in that investment, and when it starts to do well, you start to reap the benefits. And actually, more mature investors, what they do is, in a falling market, they invest with more vigor. Ke gore ha go nna le kwelo tlase jalo, ka gore ene o na le tsholofelo ya gore dilo di tla boa di siama, ka gore ene o itse sa se itseng, gore o reka le go heta jaanong. Because what that then means is a stock e le gore gongwe should cost 1 pula, now cost 50 tebe. Now if it should cost 1 pula, it will go from 50 tebe back up to 1 pula, where it should be, which means you enjoy 100% return, right? And this is what tends to happen quite a lot, like I was saying, when stock markets do really, really well, right? So usually during pandemics or during times of recession, stock markets, there tends to be a sell-off or a sell down, right? And stock markets will take a hit. So if you look at the global financial recession that we had in 2008, for instance. Most stock markets went down by 20 to 30%.
Yeah.
But then if you look at the time after that, so if you look at stock markets from the time from say 2010 leading up to maybe around 2018, stock markets did really, really well.
Yeah.
Exactly. And now what happens is when stock markets do really, really well, we tend to get very excited. We get very excited, and now you're putting all of your life savings into the stock markets, which are doing very, very well.
Yeah.
Right?
2020 happens.
Exactly. Now, the trouble with doing that is you run the risk of buying overpriced assets. Right? So now, the same scenario, stock which is supposed to cost 1 pula now costs 1 pula 50 tebe, because generally there's a lot of excitement in the market. So now you're buying a stock or you're buying a financial asset at more than what it's worth. And then, like you're saying, 2020 happens. Market correction nearly always happens, right? So 2020 happens and asset prices start to fall. Now your 1 pula 50 becomes 1 pula becomes 50 tebe, right? So that's where it's important to manage your emotions, because there will always be two sort of there's market cycles, right? So there'll always be two sort of points in those market cycles. There'll be the peak, which, like we're saying, probably the period between 2010 and maybe 2018, 2019. There would have been some nice peaks there where financial markets are doing very, very well. And there'll be some lows or some troughs, right, where financial markets are not doing very, very well. Right? So say, for instance, like we said, March of 2020 it was, right, when we were in lockdown. Most markets were down again 20 to 30%. But if you manage your emotions throughout those highs and those lows, and throughout the highs, even though emotionally you are excited, it's probably not the right time to buy. Throughout the lows, even though you're a little bit depressed, even though you're a little bit worried, it's not the right time to sell out of financial markets. What you should be doing actually is the opposite, is buying more. If you can manage these emotions, if you manage them successfully, then you'll probably make yourself quite a killing with financial markets. And this is what the most sophisticated of investors will do. And a big part of it is, one, again, like we said, know what your objective is, know what your time horizon is, and invest for the long term.
Yeah. Wow. I think you've summed it, quite well. So we learn to manage our emotions. We are most likely going to win when it comes to investing. And the same applies in life generally. In marriage, it's a long-term thing. You manage your emotions. You're probably going to be married for a very long time. You're raising kids, starting a business, because, turbulences will happen. One day you'll be doing well, contracts will be coming. At some point, contracts are not coming. What were your emotions when you started the business? Was it greed? Was it fear? And then when something happens along the way, it just triggers those emotions, and then you find yourself maybe now shutting down or moving to a different business. I think we need to, have another.
Sorry, just before you move away from that, I really like that example that you gave. It's exactly like marriage, because if you know what marriage is, if you know what a relationship is, it's during those downturns that your marriage becomes really, really strong. Right? If you manage your emotions during those really, really bad times, that's when you bond even closer with your partner. But if you listen to your emotions telling you to run away, then you're potentially losing something which could have been very beneficial for you. So it's the exact same thing with financial markets. During those downturns, you need to be very, very strong. Right? You need to have a very strong conviction. And when you do, when things turn around, you'll benefit very handsomely for it. So I really like that example that you gave.
Absolutely. Mr. Howard, I think we are going to have to, call you in for another interview, because there are so many things that need to be discussed around this topic. And our obsession is really getting Botswana to learn about these things in the simplest manner. You know, we don't want to sophisticate the language because we don't want them to fear to come and invest. It's our madi a mantsi mo marketing. We are holding on to money. We can become rich with what we earn. But if we don't think about our earnings, we don't respect our money, we think long term, we are probably not going to achieve any form of wealth during our lifetime. So thank you so much for coming. So if people want to get a hold of you, ba batla go ikopanya le wena about the services that you offer at Gore Capital, ba ka ikopanya le lona ko kae?
All right. No, thank you very much for asking that question. So anybody who wants to
Look at that camera.
all right, thanks. Anybody who wants to have a look at it, anybody who wants to get in contact with us, please contact us on 399-2400. Go on to Google, just Google Gore Capital, and I'm sure it'll be it'll be actually the first result that comes up, or www.gorecapital.com is our website. We've got a lovely website, very informative. Get a hold of us. You know, we're always very open to answering questions. We do understand that investment is something that not everybody understands, but a lot of people do want to get into it. All of us need to be invested. So even if you have a very silly or what you believe is a very silly question, get in touch with us and we'll always be very glad to help you. And it's always a pleasure, like I said, to be here with Masheleng. We really love what you guys are doing, informing our community, our society about what good financial literacy, good financial methods, good financial well-being, what all of that is, what investments are. This is something that, you know, we believe in the long term will really benefit our country. And because of that, you know, we're always happy to come over this side. Thank you very much.
Wonderful. All right. Thank you so much, Mr. Howard.
Thank you very much for watching. I hope you enjoyed today's episode. And if you want to engage with us or for collaboration, please call us at 3950026, 3950026, or check us on our social media pages at Ignite Wealth or the Masheleng magazine. See you on the next episode. Barok.
Hi, I have a free gift for you. If you want to claim this gift, go to www.masheleng.online/gift. In this gift, you will learn how to become financially free in 5 years or less.